Assalamualaikum and welcome to chapter 8 with the new topic on risk and return. There are 4 learning objectives to be achieved by the end of this chapter. So the first one is to understand the relationship between risk and return. Second one, to understand human attitude towards risk. To understand how risk and return is measured and quantified. Finally, to understand the various types of risk that a finance manager and an investor faces. Okay, as a financial manager in a company, the main job is to be able to invest surplus money in any possible types of asset, okay, in order to earn appropriate rate of return on the investment for a particular time period. For example, rate of return for a period of 1 year. So the types of asset that can be invested include stocks, bonds, real estates, marketable securities, gold, and many more. So the rate of return on investment to this asset can be measured using this formula. Okay, where the annual income plus ending minus beginning price divided by the beginning price. Okay, what is annual income? What is annual income? If you invest in stock, then your annual income is the total dividend that you receive in a year. If you invest in bond, it's the coupon payments that you receive. And let's say you also invest in real estate, then your annual income is your total rent in 1 year period. Okay, this is how you measure your rate of return for a particular period. Now you also need to understand that every target return that you expect to achieve from your investment will always link to the risk inherent to it. Meaning to say, every invested money can make higher returns only if the investor will accept a higher possibility of risk. So this is what we call as the risk-return trade-off. As there are many investment avenues for the firm to invest, financial and investment managers need to really understand that the riskier the opportunity, the higher the return might be. Now let us analyze and appreciate what would have happened if we had invested money in the stock index FTSE Malaysia Kuala Lumpur Composite Index versus Malaysia 5-year bond. These two tables give us a comparison between the gap of price range over the period of 1 year or in 52 weeks. Okay, you can see here. Okay, and here. This is the range price. You can see here that the price gap for stock is much higher compared to bond within the same period, and this also could indicate the higher price volatility for stock, and thus it is considered as more risky investment compared to bond. The higher the volatility on the price, the higher the uncertainty on the return. Having said that, the decision to invest in which types of asset will normally depend on our attitude or our appetite towards risk. Broadly, human attitude toward risk can be classified into 3 main categories. The first category is risk-neutral behavior. Where investors seek the highest return without regard to risk. For a risk-neutral people, the level of risk does not matter to them, as long as the return is commensurate. Risk-averse behavior is the tendency of people to reject a bargain with an uncertain payoff. Okay, so this is the second behavior. Investors who are risk averse normally prefer to invest in a low risk investment with a low but certain return, rather than investing in high return investment but with high risk. Finally, risk seeking or risk loving behavior. This type of investors are investors that have a taste for risk and will take risks even if they cannot expect a reward for doing so. Such a person takes a risk because he or she enjoys the challenge in the risk itself. So for those investors who agree and prepare to take some amount of risk in their investment, like a risk seeker, it is important that the risk associated with the investment can be quantified in a systematic manner. Now we will look on how to measure risk and return in the case of investment in stocks or shares as an example. The first example is to measure risk and return using probabilities, while the other example using historical data. I took these examples from your textbook and share it here so that everyone can easily understand by referring to the same case. Typically, you can measure the expected or mean return of share A and share B respectively by finding the sum of possible returns with associated probabilities. Risk, on the other hand, can be measured using the standard deviation of return for share A and share B. Okay, you will calculate risk using standard deviation. Okay, why do you think standard deviation is used as a measure of risk? If you still remember what you have learned in your statistics subject, standard deviation is used to find the dispersion of a set of data from its mean. The larger the dispersion, the higher the standard deviation will be. So in the context of stock return data, the larger the dispersion of each stock return data from its mean, the higher the uncertainty of the return for investors to predict. Thus, the higher the risk of that particular stock. From this example, you should note that share B has a slightly higher mean return compared to share A, and it also has a higher level of risk as evident by the higher standard deviation on share B. Okay, this is a mean return for share B and standard deviation for share B. This example, on the other hand, shows on how risk and return are measured for share C and share B respectively using historical data from 5 years back. In this example, share D has a higher mean return and thus higher standard deviation compared to share C, as the common saying of high risk, high return. So this is the mean return of share D, which is higher compared to mean return of share C, and as well as the standard deviation of share D is higher compared to the standard deviation of return for share C. This slide and the previous slide prove that risk can be quantified from the available set of data. But what kind of risk that actually influence the pattern of the data? Fundamentally, there are various types of risks faced by any businesses in their day-to-day operation. These three risks, which are regulatory and policy risk, sales risk, and project risk, are the common risks concerning investment managers in all firms. Some of these risks are possible to be managed and diversified because they are within the control of the firm. However, some form of these risks are likely to be there in any asset, though not in the same shape and extent. Apart from investment manager, a finance manager also need to be aware and manage various types of risks that might expose the firm to any unforeseen circumstances. Those possible risks include cash flow risk, capital structure risk, default risk, reinvestment risk, interest rate risk, currency risk, and liquidity risk. So to further understand these specific risks, please do consider to read the explanation from your textbooks or any other reliable sources. So, I guess that's all for chapter 8, and for your information, chapter 9 for next week is the continuation of this chapter. So please make sure that you really understand this chapter first before we proceed with chapter 9. Thank you for your attention, and Assalamualaikum.